Financial markets, particularly for commodities, have been volatile in recent weeks, but they are functioning. The economic outlook is uncertain and undoubtedly a very challenging one for many households and businesses. The banking system is resilient to that outlook, however, or indeed even a much worse one. And that's a sharp contrast to the financial crisis. We have a system that is in a position to cushion the economic shocks, not to add to them. Since the last FSR, which we published in December last year, the global economic outlook has deteriorated markedly. Global financial conditions as a whole have tightened significantly. This is in part due to central banks across the world having tightened monetary policy in response to the outlook for inflation. Market interest rates and corporate bond spreads have also risen, in part reflecting expectations of further tightening of policy. And developments in Russia's invasion of Ukraine are a key factor affecting the global outlook. That said, banks continue to hold overall capital and liquidity resources sufficient to support lending to the UK economy, even in severe economic outcomes. And those severe economic outcomes can include weaker economic growth globally, a further sharp tightening in global financial conditions, and the potential for further volatility and stress in financial markets. So despite the weaker outlook, the UK banking system remains strong. And in line with expectations, although capital ratios declined in the first quarter of this year and are expected to fall back slightly over coming quarters, all of which was expected, I want to underline this point that we have a resilient system. The report highlights some of the financial stability risks posed by the recent volatility in global commodity markets. Since the Russian invasion of Ukraine, there have been sharp spikes in the prices of gas and other commodities. These spikes have led to steep increases in margin requirements for the financial contracts used by commodity suppliers to hedge their risks. Margin requirements are an essential tool for reducing risks in the financial system. In the early period after Russia's invasion, the sharp and sudden increases in these requirements made it harder for some commodity market participants to meet them. This put pressure on some commodity firms' liquidity positions. As a result, banks faced significant calls from their commodity firm clients to lend to them in order to then fund their higher margin requirements. Now, despite this price volatility, commodity and wider financial markets overall have continued to function. But in one particular instance in March, the London Metal Exchange temporarily suspended trading in nickel contracts and cancelled trades due to a specific set of circumstances that contributed to an extremely sharp price spike. Looking forward, the uncertainty surrounding the Russian invasion of Ukraine means that there remain significant risks of further disruption in commodity markets. The recent disruption has highlighted how vulnerabilities within commodity markets and interconnections with the wider financial system could amplify shocks to the real economy. Some of those vulnerabilities are similar to those in the wider system of market-based finance. Quantifying the size and scale of these fragilities and interconnections remains challenging for a number of reasons. There is considerable opacity and a lack of data in some markets, and some of these fragilities relate to physical markets, non-financial entities, or entities in other countries and outside the UK financial system. This means that addressing them will require engagement from a broad range of financial and non-financial authorities, both domestic and global.